Welcome to This Explainer. I'm your host, and today we're diving into the high-stakes, kind of hidden mechanics of massive corporate finance. We're going to be looking at a financial instrument that quietly runs the global economy, literally dictating how massive companies raise funds, how they handle their debts, and, maybe most importantly, who gets paid when things go terribly wrong. We are going to unpack the fascinating world of debentures.
Okay, let's just jump straight into the real-world impact before we get bogged down in technical definitions. We often think of giant corporations as these untouchable juggernauts, right? But they actually have a massive, fatal vulnerability. If a company fails to pay a bond, well, that failure effectively means bankruptcy. It really is that serious. Bondholders who haven't received their agreed-upon interest aren't just out of luck. They can actually throw the offending company into bankruptcy proceedings. Or, depending on their specific contract, they can sometimes bypass that whole process entirely and simply seize the company's assets. That is an absolute immense amount of leverage held by the creditor over the debtor, and it fundamentally shapes how corporate risk is managed.
And it's this incredible power that gave rise to a cultural trope you've probably heard of, the idea of the wealthy clipping their coupons. Back in the day, this obviously wasn't about saving 50 cents on a box of cereal. A bondholder literally held a physical document, and they would snip off a small physical piece of that paper to present to a bank. They'd do this every quarter, or whatever the agreed period was, just to receive their interest payment. It essentially became the ultimate symbol of passive income, drawn directly from the legally binding debt of massive corporations.
So, to understand what gives a person or an institution that kind of power over a corporation, we're going to cover 4 key areas today. First, we'll go back to basics. Then, we'll look at minimizing the risk. Third, we'll explore the convertibility factor. And finally, we'll see how debentures work around the world.
All right, Section 1. Back to basics, defining debentures. Let's peel back the layers here.
So, the absolutely crucial point is understanding what this instrument actually is. In corporate finance, a debenture is a medium to long-term debt instrument that large companies use to borrow money at a fixed rate of interest. Historically, the legal term just referred to a document that either creates a debt or acknowledges it. Think of it like a certificate of a loan. It's evidence, whether physical or digital, of the company's liability to pay a specified amount plus interest. Now, the best way to wrap your head around this is to contrast it with buying stock. When you buy stock, you're buying ownership. But the money raised from debentures becomes a core part of the company's capital structure without ever becoming share capital. You are strictly lending, not owning. And there's a very strict hierarchy. Senior debentures always get paid out before subordinate ones. And in that worst-case bankruptcy scenario we talked about, debenture holders get paid out before stockholders see a single dime.
Which brings us to a kind of hilarious quirk of corporate law. Despite being an absolute bedrock of corporate finance, the term itself is way more descriptive than definitive. An exact catch-all definition has actually proven pretty elusive to legal scholars. The esteemed English commercial judge Lord Linley actually admitted this in one case, saying, "Now what the correct meaning of debenture is, I do not know. I do not find anywhere any precise definition of it. We know that there are various kinds of instruments commonly called debentures. It is just wild that an instrument with the power to liquidate a multinational company can be so hard to perfectly define in a courtroom."
To put the scale of these into perspective, let's look at standard denominations. Corporations in the U.S. generally issue bonds of around $1,000. That's a really interesting contrast to government bonds, which are much more likely to be issued at the $5,000 mark. By keeping the denomination smaller, it allows a much wider variety of investors, both big institutions and regular individuals, to get in on funding corporate debt.
So if you hold one of these certificates, let's rapid fire through the rules of the game. First off, you've got a movable asset that is freely transferable to someone else. It's your official certificate of indebtedness. You get fixed, set-in-stone dates for when you'll get your principal money back, plus the interest. Interestingly, it may or may not create a charge on the specific assets of the company, and we're going to see why that distinction is a huge deal in just a minute. But remember, you leave your opinions at the door. Because it's not share capital, you don't get any voting rights in general shareholder meetings. You might get separate meetings if they want to change the rights attached to the debentures themselves, but you don't get to run the company. And finally, that interest paid to you, it's officially recorded as a charge against profit in the company's financials.
Let's move on to Section 2, minimizing the risk through sinking funds and calls. We've established how high the stakes are, so how do these corporate giants actually protect themselves?
Well, one brilliantly simple mechanism they use is called a sinking fund. Imagine owing a massive debt that's due in 30 years. Instead of just crossing your fingers and hoping you have the giant lump sum on that final day, a sinking fund requires the debtor to pay off pieces of the bond's value after a specified period of time. It acts as this powerful hedge against inflation, bankruptcy, and just general uncertainty. And because this significantly lowers the risk for the creditors, the bond is viewed as safer. And, in the financial world, less risk means you don't have to offer as big of a reward to entice buyers. So a debenture backed by a sinking fund will generally offer a smaller interest payment, which ends up saving the company a ton of money in the long run.
Sticking with that risk management theme, companies also use another really powerful tool. They reserve the right to call their bonds. This just means they can call the bond in sooner than the agreed maturity date, as long as it's written into the contract. So say an issuer wants to rebook a 30-year bond at the 25th year, they can do it. Usually, though, they have to pay a premium to the bondholders for the inconvenience. So why do it? Well, if a bond is called early, it means less interest is paid out overall. It gives the corporation the flexibility to restructure its debt on the fly if market conditions suddenly change.
Section 3. The convertibility factor, turning debt into equity. Let's see how corporations sweeten the deal for buyers.
It all comes down to playing with that delicate balance of risk and reward, which creates two distinct classes of debentures. Corporations can make these instruments super attractive by offering convertibility. Convertible debentures are bonds that can eventually be converted into actual equity shares of the issuing company after a certain amount of time. It's a special feature baked right into the bond. Because the buyer gets the distinct advantage and the potential upside of turning their debt into company equity if the business takes off, these bonds typically offer lower interest rates. On the flip side, you have non-convertible debentures. These are just your run-of-the-mill, standard debentures with no convertibility feature whatsoever. They can never be turned into stock. So, because the buyer doesn't get that potential equity upside, non-convertible debentures have to compensate the investor by offering noticeably higher interest rates.
Which brings us to our final section: debentures around the world and their jurisdictional rules.
Now, this is fascinating. This single financial term suffers from a massive global identity crisis. The exact same word means vastly different things depending on where you are on the map. In some places, debenture is basically used interchangeably with bond, loan stock, or note. But if you're in the United States, a debenture refers very specifically to an unsecured corporate bond, meaning it doesn't have a specific piece of property or equipment guaranteeing the repayment. If a loan is secured in the US, they call it a mortgage bond. But cross the Atlantic to the UK, and a debenture is usually a secured instrument. In Canada, it also refers to a secured loan. Up there, the security is generally placed over the debtor's overall credit rather than specific assets, but it still legally grants the debtor priority status over unsecured creditors if there's a bankruptcy.
And just to show you how deeply rooted these regional definitions are, we can look at historical examples that have used these localized structures for a century. Take the permanent debenture stock of the City of Montreal, which was issued way back on July 20, 1925. It just highlights that these definitions, whether unsecured in the US or secured in Canada, have formed the bedrock of municipal and corporate development for a very long time.
And then, let's look at Asia, where the language becomes incredibly precise based on the exact nature of the collateral. It's a total stark contrast to that legal ambiguity Lord Lindley was complaining about earlier. In Asian markets, if the loan repayment is secured by a charge over land, it is strictly called a mortgage. If the repayment is secured by a charge against other company assets, that is when they call it a debenture. And if there is absolutely no security involved at all, which is what the US would call a debenture, the document is just simply called a note, or an unsecured deposit note. It is quite the study in financial terminology, right?
So, as we wrap up this explainer, I want to leave you with this thought. We've seen how a single failed debenture can literally force a massive, untouchable corporation into bankruptcy. We've explored how sinking funds and convertibility manipulate risk, and how the very definition of the word flips entirely from unsecured debt in New York to secured priority debt in London and Toronto. These instruments are silently funding the massive corporations that build the world around us, yet they shift their very meaning depending on where you stand. If even the top legal scholars admit they struggle to find a precise universal definition, what other financial secrets are hiding in plain sight, quietly dictating the terms of our global economy? Thanks so much for joining me on this deep dive, and keep questioning the structures around you.